Of course, in the thick of earnings season, we've seen counters like Reliance Industries, JSW Steel, as well as ICICI Bank come out with their earnings post results. But today, what we're going to be talking about in more detail, of course, will be as far as HDFC Life goes. And we're, of course, now being joined by Vibha as well to talk more about the numbers that have been announced over the weekend. Vibha, we were of course playing certain sound bites from the top management when it came to the earnings. If you can first just take us to the highlights of the earning fine print, and then we'll get into all of the details.
So this performance was fairly holistic and we are fairly happy with it because all our channels grew and did well. To give you an example, our agency channel in standalone Q3 grew by 49%. Some of our bancassurance partners, other than HDFC Bank, that of course is the dominant partners, but even the newer partners grew as much as 85%. Our direct channel, our own channel, grew by 57%. So it was fairly holistic. Also, in terms of the product mix, that was very much the desired product mix. What is very heartening is that after a lull of 2 quarters because of the pandemic, our individual protection grew by 20%. And also overall protection also grew quite robustly. So for the 9 months, overall protection grew by 34%. Annuity continued to do well and exhibited a growth of about 39%. So all in all, we are, like I said, fairly pleased because of the all-round performance. To your question on COVID claims, that is something that also has gone down quite significantly in Q3. And to give you a sense of the scale in which it has gone down, in Q3, on our individual claims, we had to pay out COVID claims of only 17 crore, 17, versus if you were to look at Q2, it was about 300 crores. And in Q1, it was about 150 crores. So 150 crores going to 300 and going down to 17 crores. That has been the kind of the trajectory and sharp runoff in terms of the COVID claims. Yet, given that we are in the midst of wave 3 and Omicron, we have strengthened our extra mortality reserves, and at the end of December of last year, we are now carrying forward 155 crores of extra mortality reserves.
Now, from an industry standpoint, there is a rise in premium growth and pricing also has gone higher. Will it be able to offset the rising claims, especially the COVID claim which you mentioned?
So we've already increased our prices by about 15 to 25%, and that has already happened. We do believe that this was necessary. We are also retaining more, slightly more, from 20 lakhs to 40 lakhs. But this has no impact on our solvency because that was already, the reserving was already at a higher level. So we see this holistically, but on a slightly longer term point, I do believe that these kind of price hikes, not just in protection, but for other life as well as health insurance products, is bound to happen, very similar to any other product category which does go through price hikes due to inflation. So while there's a lot of discussion about it right now, I do believe that we need to focus more on is insurance penetration, getting more, especially in profiles that otherwise were not buying insurance. It could be non-salaried, it could be in non-metros, it could be amongst female population and so on. The focus all of us should have is on that rather than just the price hike. And final point is, I do believe that demand is not going to be so in tune with the price hikes. I think it is going to be more robust than that. And I don't personally believe that longer term there's going to be an impact on demand.
Now your solvency ratio is down after the Exide deal, largely because of the cash payout. Would you be needing capital?
So one correction is the 190% was before the cash payout, because the cash payout happened on 1st of January. So the 190% is in the normal scheme of things. Actually, the comparison with last year, wherein it was slightly over 200%, that was more an aberration. Typically, we've been in the 190%, 190, 195% zone. So nothing very unusual. Yes, it will go down after the cash payout. And you'll see this in quarter 4. 2-3 things that will happen. One is that the back book profits that will get generated in quarter 4 will add to the solvency when we end as of 31st of March. Second is we do have some ammunition in terms of sub-debt. If you recall, we've already raised sub-debt of 600 crores. We could possibly raise a little bit more of sub-debt. And thirdly, our promoters have always been very supportive. And should there be a need for capital from them, as and when we think that there is a need, that also is something that would be available. So it's a 3-pronged approach. And the last one that I mentioned would be more towards growth. As and when growth comes up and the pandemic situation is out of the way, then that's a good problem to have, and that support is there.
Right. Vibha, so what's been the difference in customer behavior, say, during the third wave, and as opposed to what it was during the second wave? Also wanted to understand what kind of structural changes do you see in customer trends going forward?
Very much. And that's one of the reasons why we found Exide Life as an attractive target. So one is, like you said, in tier 2, 3 towns, also in terms of the agency channel itself and some of the other partnerships that they have. So we feel excited about this. Now, first leg of the merger is out of the way, wherein now it has become our wholly owned subsidiary. So we have full control on the entity. Next step is merger, which is perhaps 9 months to a year away. And when the full integration happens, we'll be able to really amalgamate in terms of how do we extract synergies. But what it will add is add about 30 to 35% to our agency channel, also deepen our presence in South India. And thirdly, like we discussed, tier 2 and 3 towns as well. We have been fairly a metro focused company. So this part of our customer base also is something that we would like to welcome into HDFC Life.
Vibha, so, insurance is on the cusp of a transformation with the LIC IPO upcoming, economic growth, increased affordability, and of course, at large awareness as well. The metrics put together signaling the environment right now. Share with us what your outlook is for the entire financial year.
I'm very optimistic. I've gone from being cautiously optimistic to optimistic. I do believe that the viral strain and the wave 3 we probably peaked in several parts of India. Which means that demand and all the macro indicators are still very robust. I do feel optimistic, like I said, as we go into the next financial year. It's no longer in people's mind as to why do I need insurance? And that used to be the case not that long ago. Do I really need to spend this money into insurance, or can I do something else with it? Nothing's going to happen to me, and so on. So I think now it's no longer the why of insurance, but the what of insurance. Which product is suitable to me? Who should I cover in my family? And so those conversations are changing and have already started. So that's something that makes me very optimistic. Also, as we move more interior, away from metros, like I said, there is untapped demand. So that there's a lot going on, and also credit life, wherein we do partner with banks, NBFCs, small finance banks, as credit offtake continues to be robust. We will also piggyback on that demand to be able to cover the loans with insurance. So it's really multi-pronged. And final part is on annuity. There too, a lot of people who are close to retirement or thinking about retirement are beginning to understand that they will easily outlive their retirement age by maybe 20 years, if not more. And with inflation continuing to be there, they are soon going to have serious erosion on their savings. So how can they lock in into annuities is also something that people are beginning to understand. Our entire retirement focus campaigns is also enlightening people. So it is really multi-pronged in terms of opportunities for the life insurance sector.
Vibha, I like that. From cautiously optimistic to optimistic, you've addressed penetration as well, about how you don't need to have a narrative on why insurance is important. So with that, can we talk a little bit about your product strategy? The management at the time of the earnings has, of course, said it's going to be balanced. But if you can tell us more about that, what the product strategy is going to be for the year.
So we're very close to our ideal product construct, which is about one third to one fourth in that range. Lower end is unit linked, about a third to be participating products, another third to be non-participating savings products, and the recent launch that has been very well received, which is our Sanchay fixed maturity plans. To give you a sense, in the first 75 days after launch, we have garnered 300 crores. So it has really been well received by our customers. And the rest in protection and in annuity. So that's very close to where we are today, but with a focus on protection and annuity.
Now, in insurance, the parlance that, of course, is used is about VNB margins, which is, value of new business. That has been recorded at 25% by HDFC Life on the back of higher volumes as well as a balanced product mix. Is this sustainable? What is your outlook and guidance going forward?
Margins will continue to have a smooth upward trend. We have done fairly well in this quarter. In this quarter, on a standalone basis, we have gone up from 26.4% to 26.8%. And on a 9-month basis, there has been an improvement in margin from 25.6% to 26.5%. And consequently, a growth in our value of new business by 26%. So that smooth upward curve will continue to be there.
Okay, Vibha, we are going to leave it at that. Thank you so much for joining us today on the show to take us through the fine print of the earnings and, importantly, the guidance also going forward. Convinced that the 25% margin guide is sustainable, in fact, can grow.